Hi, good morning. I think we ought to be starting. What I've got is the presentation, the latest presentation on the screens. It's entitled Inflection. It describes the results of the data update to the end of November, looking at liquidity data and investigating what it's saying. The main points are basically put here. This is kind of a repeat of what we've been saying for the last few months. There's not really greatly any difference. I think it's just reinforcing, latest data reinforces these trends. And just to recap on what these 7 points are, the first is that we're seeing, in our view, a V-shaped rebound in both markets and in economies. That's being reinforced, we think, by latest data. More controversial point, has the long-term trend in GDP slowed or quickened? Our view is that it's likely quickened, and that's because of the advance of technology. More people are going to be investing in new technology over the next 2 or 3 years as a result of COVID and maybe some of these underlying trends. And secondly, there's been a very clear signal by governments worldwide that austerity policies have now finished. And that was, if you like, formally underscored by the IMF's economic outlook piece in October of this year, which more or less formally said no more austerity and encouraged many emerging markets to resume their borrowing. Will high street inflation restart? Our view is that it will do. We're clearly not going back to the high inflation era of the 1970s, but there'll still be a meaningful upturn in inflation, which I'll touch on a little bit later. Is the dollar peaking? Well, it has peaked, it's coming down. It's likely to weaken further. What you tend to see in terms of long-term history of the dollar is that the dollar sees a secular downtrend with upward spikes. The downtrend is really a question of continual excess supply of dollars. In actual fact, that's really part and parcel of why the dollar is the main vehicle currency in the world economy. The main source of borrowing as a funding currency is because it tends to lose value in the longer term. It's an attractive vehicle in that sense. But you see periodic spikes when there are excess demand for dollars, as we've just seen really over the last 5 to 10 years. That's now ebbing. Fifth point, is this risk on? Well, I mean, clearly this year has been strongly risk on. That was our original take after the huge amounts of liquidity that went in. It should continue into Q1. I mean, we're slightly hesitating on that score because markets don't go up in straight lines, but generally Q1 should be. The really problematic quarters are Q2 and Q3 of next year, when you're going to get a lot more evidence about the strength of economies. And the plain fact is that strong economies do not have strong financial markets. And that's really a long-term rule. We've got to be very, very cognizant of that. The best times to invest in equity markets and risk assets are when you've got central banks trying to stimulate stubborn or sluggish economies. And that's clearly what this year, and central banks have moved with alacrity and in size. Are equities in a bubble, therefore? There's no real evidence about a bubble given liquidity data. Our point is not so much that there's a bubble, it's more that the liquidity support will fall away as more liquidity goes into the real economy. Are bond markets in this environment a safe asset? Absolutely not. We continue to believe that, and all the evidence points to the fact that if you take the US Treasury market, it should be nearer 2 to 2.5% yield base at the 10-year level, not sub 1%. So let me just turn to the liquidity picture. This is an update of the data that we've been tracking for many years, shown as an index between 0 and 100. What it's showing is the first signs of inflection. As the text on the top right says, there's no reason for panicking yet. Equity markets and risk asset markets can still do well as liquidity starts to fall away, at least in the early stages. But you've got to be cognizant of this fact. It's certainly vital to plan looking ahead into 2021, either to start to shift away from risk assets or certainly to begin to move towards laggard areas or areas that are going to get more of the boost from cyclicality in the world economy. And as you can see from the timeline at the bottom, effectively what we see is a process whereby liquidity shifts through different asset classes. It moves through equities before it gets into real economies. And we're moving into the stage where the real economies are starting to benefit increasingly from more and more liquidity. The early signs of inflection are basically shown on this diagram, which basically looks at two different cuts of liquidity. The one on the left-hand side is looking at a geographical split between the Eurozone, the US, and emerging markets excluding China. We've taken China out mainly because it's, first of all, the elephant in the room. It's got such a huge footprint in the emerging market aggregate that it distorts it so much. And secondly, because China, as you'll see, is doing something very different. The point, though, is that most of these, if not all of these countries, are basically seeing quite a significant peaking of liquidity right now. So again, to emphasize the fact, this is not a reason to panic, it's a reason to be aware. If you look at the right-hand chart, that gives further evidence. And what it shows is the split globally between policy liquidity, what central banks are doing, and private sector liquidity is what the real economy is actually creating net into financial markets. Now, what this is basically confirming is that it's central banks which are still the main game in town. They're the ones that are actually supporting markets with very loose liquidity conditions. And there's no real sign of this dropping significantly yet. So they've still got the money taps open fully. What we're seeing is this inflection, or more clear inflection, coming in private sector liquidity. Now that's basically because the free cash flow, principally of corporations, is starting to dip down. And the reason for that is they're using more of their cash flow to actually fund working capital demands and future capital investment. So the free cash flow of the corporate sector is starting to dip, which is a good sign for economies, not necessarily a great sign for financial markets, because it's saying that money is being drained. So the key point here is that it's not the fact that central banks are tightening, as this next flow chart says, it's more the fact that money is moving into the real economy. And the way that we analyze financial markets is thinking about this distinction between an asset economy and a real economy. All money that is anywhere must be somewhere, but it's either in the asset economy or it's in the real economy. It can't be in both places. And what we see, as this flow diagram confirms, is that money moves from central banks into the asset economy first of all, and then it migrates into the real economy as economic expectations or anticipations pick up. And that's the phase we're now seeing. It's not the central banks are tightening yet. That may be an event that ultimately comes in 2021, 2022. But ultimately, we're seeing this move of liquidity into the real economies. There's evidence of that in the left-hand chart here. These two graphs are really showing the power of liquidity or cash. I make again the point that strong economies rarely have strong financial markets. And what we can see is the evidence of that. On the left-hand slide, we've put together the yellow bar is developed world business confidence. This is all the major surveys. So it's looking at things like the Tankan in Japan. It's looking at the CBI survey in the UK, the ISM PMI survey in the US, Eurozone equivalent surveys, etc. Similar surveys from other countries, Australia, Canada, etc., around the world, and weighted by GDP and shown as the yellow bar. So there's been a little bit of a dip recently as we get a second wave of lockdowns, but generally we're not seeing this collapse that we saw back here in February, March time. Liquidity is the red line advanced by 12 months. It's got a very good track record of predicting future turns in the economy about a year ahead. And what we're suggesting here is that economic activity remains elevated. The chart on the right-hand side is a very simple measure of liquidity shown as a year-on-year rate of change in that sort of brown-orange line, with our projections of what's happening in 2021 through to the end of the year. This is a dollar-based aggregate of liquidity worldwide. It's a figure which by the end of 2021 will reach something like 175 trillion. That compares with what it was at the end of 2019 at about 131, 32 trillion, that sort of figure. So an enormous increase in that timescale. But what you're seeing is the first evidence of a dip. The black line is showing the value of all wealth, financial and real wealth, including precious metals and housing. And that's the year-on-year return or rate of increase in wealth, aggregate wealth. There is a base effect hidden in that black line. And in truth, if you extrapolated at current levels of wealth, of asset prices, in other words, to the end of this year, you would see something like a 10% increase. So that is already baked in the cake, but it's not yet evident in that year-on-year change. But it's there if we rolled on to year end. If you look into 2021, there's a clear inflection coming in liquidity, which is what we're more concerned about. Here is the evidence on economies that I think is worth thinking about. First of all, on the right-hand chart, this is disaggregating Europe, the US, and Asia in terms of those business surveys. What I think you can see from the evidence is actually what anecdotal, maybe even media reports tell us, and that is that in the case of the European economies, there is a more pronounced dip as we go through into this second lockdown. It's not anything like what we saw in March, April, but it's certainly a noticeable dip going on. The US is seeing a little bit of that, not by the same degree. Asia is not showing any evidence at all. And in fact, that seems to be reinforced by latest data coming out of Korea on exports through to mid-November. Again, things seem to have speeded up, not slowed down. So the Asian economies look pretty robust. There's further evidence if you look at the left-hand chart, where I thought it would be interesting to look at what both world trade growth has been saying. And this is an aggregate we put together, which comes from both shipping freight rates and from volumes such as coming out of the CAS and WRI monthly surveys. So that's the yellow line, and that shows that very clear rebound in world trade. Now, just as a sort of up-to-date view as to what that is, whether that's falling or still rising, we put on here international shippers' share prices. So this is things like UPS, FedEx, things like Deutsche Post, and various companies that are quoted, but looking at how their share prices deviate from trend against world trade. And you can see there's a very great consistency here. So it looks as if, looking at what investors are thinking about the background for international shippers' share prices, that world trade continues to rebound. There's no evidence of a major dip going on. Why is that? Simply because the amount of money that's been thrown at economies is both huge in terms of size. Here is the evidence that we're seeing in the US on the size of the liquidity injection. It's something like 5 times what we saw following the 2008-2009 GFC. And you can see by this yellow spike, the scale. It's continued to grow through this period. But more importantly, if you look at the right-hand chart, much more of this liquidity has gone into narrow retail aggregates that consumers will spend. It's not really gone to the same extent into broad liquidity or wholesale liquidity that is in financial markets. Now, clearly it's gone there, but what we're saying is that at the margin, there's a lot more that's gone into retail bank accounts. So that's suggesting that the economy has got a lot of potential to rebound next year when that money gets spent. The other piece of evidence is that it's very wide, this expansion in liquidity. These are heat maps which show liquidity market by market. The top block are the major developed economies and a couple of emerging market big hitters. And then what you've got is what you've got here is a few emerging markets, particularly China, which is shown in red. And then at the bottom, we've got the emerging markets coming through here, which the evidence of emerging markets, which really confirms this general picture. China is an anomaly. There's also Russia down here, which is an anomaly. That's Russia is largely a result of oil prices, low oil prices. China is much more a deliberate policy, but I'm going to address China a little bit later in more detail as to what's going on. Aside from those two anomalies, every other country is virtually running very loose monetary policies right now, with liquidity being abundant in most economies. Is this a V-shaped recovery? Well, look, here's the evidence. I mean, anyone can judge looking at this. The left-hand chart is looking at business surveys, and the red line is where we are currently. The yellow line is the 2008 global financial crisis rebound. Effectively, I think what we've done here is that rather than taking 2 years to recover, recovery has basically occurred in about 6 to 7 months. The same evidence is shown here in world trade. This was, the yellow line was after 2008 GFC. The period is running through to effectively 2008 through 2010. Again, you saw this 2-year window it took to rebound, and even then it was not strong. But basically what we've done here is seen a very, very sudden rebound. That may be led by Asia or the strength of the Asian economies, but it's a realistic pickup in the world economy. What is the outlook for bonds? Well, as you probably heard us say before, not great. Two pieces of evidence which show this. The left-hand slide or the left-hand chart on the slide is basically looking at a factor model that tries to predict what the US 10-year bond is doing using a handful of concurrent economic indicators. Those are predominantly the US ISM index, the copper price, the gold price, and the Aussie dollar, US dollar cross rate. All those are indicative or symbols of cyclical recovery. And all of those are suggesting that the bond yield in the US should be substantially higher than it is now. The other piece of evidence is looking at the right-hand side, which is looking at the net supply of treasuries and also a subset of that, duration, where we define duration as any government bond of 5-year tenor and above, 5-year maturity and above. Now, what those two charts are illustrating is the monthly track of net supply, and this is what the Treasury is issuing minus what both the Federal Reserve and foreign investors are actually taking up. So that's the residual that's left for the domestic private sector. And what you can see is after the crisis, where the Federal Reserve came in and bought huge amounts of treasuries and duration, what you've seen now is a sort of step up in issuance. And where we were running, take the duration line, the red line as an indication, we're running at something like 120 billion a month before the crisis. It dropped to virtually nothing in the months immediately after the crisis, and it's recently stepped up to a level of about 180 to maybe perhaps 200 billion. So there's almost a doubling in net issuance of duration. And that's what we think is likely to persist through 2021. And this is, of course, net after what the Federal Reserve and foreign investors are taking off. So there's a headwind for bonds. The other headwind that's worth considering is the inflation outlook. Now, we've spoken about inflation a number of times. One of the things that we are concerned with is that inflation picks up next year, it accelerates. There's also evidence of that occurring now, not only in the reported CPI in the US, but also if you look at business surveys, particularly if you take the monthly ISM and look at the prices paid question. There's a very clear step up, both in that and in some of the regional Fed surveys. So there's clear evidence that inflation pressures are rising in the US, but also worldwide. Now, can we get more of a handle on that? What the chart is basically saying is that we're stripping out two types of inflation. And those are the key ones to think about from a policy and from a market perspective. The first of those is monetary inflation. The second is cost inflation. Now, the two basically are self-explanatory, but cost inflation is really what the private sector itself creates. And in the very long term, the private sector tends to create cost deflation or certainly disinflation through its own activities, particularly productivity enhancement and attempts to reduce costs over time. The state sector, including the central bank and the government, tends to create monetary inflation through its own unproductive spending and through just printing money and devaluing a currency. Now, if you look at those two components, we can extract those because monetary inflation tends to impact asset markets much, much more than the high street. And so we can use the asset markets or asset inflation to actually strip out the impact on high street or CPI inflation of monetary factors. And that's what we've done in this graph. So the blue line is our estimate of what the Federal Reserve or what the US government is actually creating in terms of inflation on a month-by-month basis, going right back to the early 1960s. The residual of the orange bar is the cost inflation element after excluding energy prices, which we've done through the core inflation adjustment from the US CPI. Now, what that says is an interesting picture, and that is that if you go back to the period of 1980, you can see there that the reported level of US inflation, which was around 13%, was almost exactly split 50-50 between cost inflation and a monetary inflation. But if you get into the year 2000, you can see there that cost inflation comprised virtually all of the reported 3% CPI inflation, and monetary inflation was absent or even slightly negative. What we're seeing is a different mix as we move through the 2000s decade, where it's dominated by monetary inflation, and you're actually seeing cost deflation through this period. Now, that was the period where the US Federal Reserve and other central banks should have been tightening monetary policy to get rid of this monetary inflation, but they muddled up these two dimensions. They thought what was happening was that the low inflation was a monetary deflation, which they panicked about, and consequently cut interest rates and pumped in liquidity. They should have done the reverse. Now what you're seeing is a pickup in the trend in cost inflation. Now, whether that's because of the change in the nature of supply chains, the fact that China is being cut off or isolated, the fact that you're getting rising commodity prices, the dollar is going down, demographics, etc. All those factors are pointing to, if you like, a gradual rise in cost inflation. Now, that may be not dramatic, and we're not going back to where we were in the 1970s and 80s, but it may still be a level of 1 to 2%. But on top of that, you've got the monetary inflation from this splurge of liquidity that's come through because of the COVID crisis. And that likely is going to add up to another 2%. So what we're talking about is an inflation level that may be running at around 3% plus through 2021, 2022. And it's that addition of the two types of inflation that's important to understand. Now, what does that mean for the yield curve, all these factors? We think it means that the yield curve has to steepen appreciably more. That will be good for so-called value or cyclical stocks. It may be bad for growth stocks and possibly technology. But what you're seeing is this secular movement, this rise in the yield curve, this steepening that's ongoing. The red line is liquidity. It's been advanced by 12 months, and liquidity is always a great handle on what the future yield curve will do. So it's been a little bit slow in coming this year, but we're still seeing this noticeable pickup. And we think that even if rates at the front end of the curve are held around zero, you're still looking at something like 200 basis points at the back end of the curve, which will then give you this sort of steepness that we're talking about, somewhere in this 150 to 200 basis point range for the yield curve. Yield curve steepening very much on the agenda still. Let me turn to equity markets and say what we think the prospects for equities are. Equities, we still think, have got some mileage, particularly if you start to look at different regions of the world. This chart is looking at how we evaluate the equity prospects. And what we say is that whereas the direction of liquidity is much more important for fixed income economy, it's the positioning of liquidity that is vital to understand in terms of equity markets, how much cash is in portfolios. And so what we do is we take data on total financial assets, the allocation or positioning in markets, the actual data, and we draw up this red line, which is showing the division between safe assets and risk assets. The higher this graph, this red line, the greater the exposure to risk assets over safe assets. 0 is the long-term average, a rolling 5 years, and 20 and 40 units are 1 and 2 standard deviations above and respectively below normal. The yellow line is OECD economic growth drawn concurrently on this chart or contemporaneously, and the two match up. What this is saying is that basically investors have discounted a slump in the world economy. They're still below average in their exposure to markets, but broadly speaking, we're off the lows. We're certainly nowhere near these highs, which is bubble territory. Now you can see this in another way in terms of this equation, which is basically how we look at markets. And without being too wonkish, there are two moving parts in the liquidity framework. One is the flow of liquidity, which we've ringed, and the other is the multiplier, if you like, of how liquidity affects asset prices P. And that multiplier, which is the equity to or risk asset to liquidity ratio, is what that earlier chart just showed. And basically, it's not the fact that you've got a bubble going on, which will suddenly cause this to collapse. It's more the fact that the liquidity component starts to slow down because not because central banks tighten, but because economies boom. And that's really what our concern is. Now, if you come back to the picture and you actually look at the equity to liquid asset ratio, which is shown here for the world, that ratio, which we analyze in more detail using the risk appetite indexes, that actual ratio is still around 0.5. No evidence there of bubbles. This is basically around common or normal territory. And here is the world in our risk appetite rankings. The risk appetite indexes are just slightly more sophisticated versions of this. They're normalized data series and they take into account some measure of recent volatility. What we've highlighted here are markets that look significantly underweighted in terms of investor portfolios, given prospects. At the top, you've got the opposite of markets that look, if you like, overcooked relative to liquidity or positioning within portfolios. Canada, the UK, South Africa, Italy, Australia, these markets really stand out as looking pretty cheap. Thailand, Singapore, even Germany is below average. The markets that are up here that look to be extended are things like Taiwan, Sweden, and the Netherlands. Korea is up there. France is up there. India is up there now. Japan is slightly above average. Eurozone slightly above average. US tad above average. Generally, it's this bottom fishing area that looks much more attractive. And actually, many of these markets are in the commodity space, particularly South Africa, Australia, Canada, that are well worth looking at, or even Indonesia too, and New Zealand, which are all in this block of markets that are out of fashion. Let me say a little bit about the dollar outlook. Whereas positioning of markets against liquidity is important for equities, and the direction of liquidity is important for bonds, it's the mix of liquidity that really is key for the dollar and currencies. What we show on the left-hand graph is basically the picture there in terms of private sector liquidity versus what we call policy or Federal Reserve liquidity. It's the differential, if you recall, between these two series that drives our Forex risk index. And it's that Forex risk index on the right that drives the future movements in the dollar, which is shown here as the DXY index deviations from trend. So the yellow is the Forex risk index. That is defined as the differential between the graph series on the left, which is policy liquidity and private sector liquidity. When policy liquidity is above private sector liquidity, the Forex risk index starts to fall rather into this negative territory, and it's showing that high risk for the dollar. So what we're beginning to see now are periods where the yellow line is inflecting downwards. The Fed is actually also coming off the board a tad, but you're seeing this drop down in private sector liquidity, largely because working capital demands from US industry taking liquidity out of financial markets. Periods historically where the yellow line, private sector liquidity, has been above the red line, policy liquidity, have been periods where the dollar has been very strong, such as this period here that we're looking at through 2012, 2016 on the right-hand chart. That's been an extremely good handle on the dollar looking forward. Now, the other factor that we've got to look at, which goes into the private sector liquidity component, is what foreigners are doing. And this chart we've singled out before, but it continues to reinforce our view about how the dollar picture is unfolding. What you can see here is movements in world capital flows between various regions. Europe in red, Asia in yellow, the Americas in black. Read that as the euro area, the dollar area, and let's call that the yen yuan or renminbi area in yellow. Now, what you can see are three periods here that we've highlighted where there have been massive inflows into the US dollar area. One in the mid-1980s, when Japanese insurance companies were aggressively buying US treasuries really for the first time. That led to a lot of strength in the dollar. Then we saw the 1997 Asian crisis, where you see again a spike into the dollar as investors from Asia headed into safe assets. And correspondingly, both these two periods of dollar inflows correspond to big outflows from Asia, as you can see here in yellow. And then we get to the latest period of spike, which comes, we think, because of the Basel III safe asset boom to a very large extent, causing demand for dollar assets at a time when the Eurozone wasn't supplying safe assets. Bunds were actually negative supply at that time. There was the Eurozone banking crisis, which caused capital outflow from the Eurozone, shown here in red. There was also the lockdown on capital, if you like, by Xi Jinping in China with the anti-corruption drive and the encouragement for Chinese banks to stop dollar borrowing or close their dollar borrowings, which saw these big outflows from China here. And that basically went into the US dollar. This spike is now dissipating. It's trending lower. It's still positive, but it looks like it's heading into negative territory. Money is very clearly moving into the Eurozone. Money in the Asian bloc is effectively going sideways. That sideways track, as we've argued before, we think is to a large extent because the Asian governments are now managing their currencies. And as aside from that, one of the things that we've also noted is that October the 15th saw the signing of the trade deal between 15 Asian or Pacific Rim countries, including China, Australia, Korea, Japan, etc., excluding India, in fact. But generally, this is a trade bloc that would need a stable currency. And therefore, you've got to expect most upward movement in the next year or so to come from the dollar falling against the euro. And that's what we suspect is happening. Let me finish with some words about emerging markets, because emerging markets will likely still be good performers as we go into 2021. One of the things that we've been railing against in recent months is the sort of common thought, widespread thought, that emerging markets have suffered a whopping great hemorrhage of money over the COVID period. That simply has not been true. There was a spike of outflows, as you can see on the left-hand chart, but if you put this into the context of 20, 25 years of capital flows into emerging markets, you can't even see it here. So it's nothing like what we saw in 2008 or even at the time of the Asian crisis. It pales into insignificance. There was no real money leaving emerging markets, and all the selling that you saw was principally selling on Wall Street by US domestic investors, as we kept saying. Emerging markets were not really responsible for any of those big sell-offs. That has really meant that emerging market Forex markets are beginning to stabilize again. And that's what these two charts principally say. What you've got on the left-hand chart is showing the JP Morgan Emerging Market Forex Index, evidencing the stabilization of late. It's not back to where we were pre-COVID, but it's basically stabilizing. The black line here is the deviations from a 3-year trend. And that 3-year trend is reproduced here as the red line. And here is our Forex risk index against the US for emerging market currencies. Everything is saying that these currencies are going to be stable. Now, our sort of cri de coeur about emerging markets is that every emerging market crisis is first and foremost a currency crisis, and we're not going to get any currency crises. So effectively, emerging markets look to be a lot more robust. Now, you can also say that if every emerging market crisis is first and foremost a currency crisis, then every emerging market boom is made in China. And what we're seeing is maybe the beginnings of that effect. Now, one of the things we noted in our monthly report was a visit by Xi Jinping to the hometown of a well-known Chinese capitalist that the Communist Party of China have wheeled out many times before when they want to emphasize enterprise initiatives in China, and they want to, if you like, underscore supply side reform. And that seems to be what may be going on in China right now. On the face of things, the left-hand chart, which is looking at PBOC liquidity growth in red versus emerging market central banks excluding China, basically says that all the action is outside of China and the PBOC is tightening. Correct. That's what is happening in reality. The PBOC is tightening or not running a particularly loose policy, certainly compared to what it was doing back here at the beginning of the chart. Emerging market central banks, however, are easing again quite aggressively, and that's coming through because of the stabilization in their currencies. So what's going on in China? What is the reality? The reality is that there's another policy lever that people are missing. And the reason that the PBOC is running this tight policy is because they want to maintain stability in the yuan during what has been a volatile period for Forex markets in the emerging market arena. So they've basically kept conditions pretty tight there. That may all be relaxed in coming weeks, but for now, we've got a situation of tightness from the PBOC. The authorities in China, in fact, the PBOC and another guys, have actually been operating another lever of monetary policy that has really gone much unnoticed, and that is the revival of the shadow banks. Shadow banks in China supply about a third of total credit, and they're particularly important for small and medium-sized enterprises. And what you've seen in the last few months is a very rapid increase in growth in shadow bank lending, certainly relative to what the state-owned banks are doing. Now, the state-owned banks remarkably show an absolutely straight line lending path where lending grows at about 13% per annum. And that doesn't vary very much at all. So the money tap is sort of constantly open, feeding state-owned industry. But the cycle in the economy and the cycle in world commodity prices is largely dictated by the movements in shadow bank lending. And these are accelerating. Actually, on Friday, we got one more observation, data for which actually showed this increasing again once more in the month of November. So there's a little bit down in October, but it's accelerated again in November, reinforcing this picture. Now, what does this mean? And this sort of comes to my conclusion, which is coming back to what it means for the Chinese economy, the world economy, and world commodity prices. Here you've got two other indicators. The left-hand graph is showing shadow bank lending, again, the same data, which is the yellow line, graphed on top of the Liquidity measure of Chinese economic activity. Now, just to refresh, the Liquidity is the premier of China, or the number 2 behind Xi Jinping. And he made a statement several years ago which said, I don't bother, this is him speaking, looking at Chinese economic data. What I look at is a variety of things, such as electricity consumption, blah, blah, transport, rail shipments, whatever. And that was encapsulated in something called the Liquidity Index that economists began to look at. And here is Bloomberg's version of that Liquidity Index, which is a temperature gauge or barometer of Chinese economic activity. Not a bad one, I'd say. here is shadow bank lending. You can see that the two move very closely, and shadow banks often are a driver of what's going on in the Chinese economy. The chart on the right-hand side is the same Li Keqiang index, the red line, and the yellow line is world commodity prices. This is the CRB index. And what you can see here is the year-on-year change. So this is the actual Li Keqiang index against the year-on-year change in the CRB. The two line up very well. I haven't cheated by taking the last 10 years. This is actually when you've got evidence of the Li Keqiang going backwards, it matches as well. So what this is basically telling us in aggregate is that we're moving to a more cyclical form of the or phase of the world economy. Asia and China are leading. The PBOC is not easing, but let's not disguise the fact that there is a new lever of policy, which is the shadow banks. It's likely that that will be joined by formal PBOC easing in coming months, and that will cause the Chinese economy to accelerate into 2021. What is China going to do with that money? It's likely that they're going to do a lot more infrastructure spending. They're already building inventory, which is why world commodity prices are picking up. They will be joined by the US and ultimately by Europe in that world recovery. And as that world recovery gathers steam, money will be sucked out of financial markets. Watch out Q2, Q3 next year for some weak equity markets in our view. The first quarter should still be okay, but you can note a hesitation there because markets don't go up in straight lines. Rotation is the name of the game. And as we said, sort of right back in this slide, you've got to start looking for markets that have been lagging in the general equity market boom. The UK sticks out as being an extremely cheap market, but so does Canada, South Africa, etc. Thank you very much. I'll see if there are some questions from anybody. I don't know if there is any chat, but there's one message. There's one question I've got here, which is the net supply of duration can be made negative again, and the supply of surplus liquidity above the real economy's needs can both be achieved with a flick of the Fed's fingers. Since the Fed has always done so at every weakness of the financial markets, will it do it again? The answer is that it may well do it again. The problem, I suppose, the problem is that is it able to do all of this on its own shoulders, given the fact that it seems likely, given that the Senate in America will still have a sort of red tinge to it, a Republican tinge, that some of the bigger support programs that were once mooted that Biden would enact are not going to be going through. So the pressure is very much on the Federal Reserve to steer the US economy. Will they be able to do that by themselves? I think it's a difficult call. They may try. So it's possible, but I think as even as Stefano, your question said, they will be reactive, not proactive to that. And therefore, if there is a wobble, markets will sell off and they will they will react to that. So we may have to prepare for that wobble first. Actually, it's true that after every wobble, buy the markets because the Fed comes back again. Let me see if there was some. Can't see any more questions, but I'm more than happy to take any more questions if people are either put them in the chat or even just unmute and speak. Another question I can see coming. What about gold? Okay, let me say a little bit about gold. Look, I didn't mention gold, but I think gold is still going up in price. The fact is that gold is a monetary phenomenon. It's not really a price phenomenon. In other words, it tends not to respond to inflation as many people think. It's a good hedge against inflation, but it doesn't tend to move with inflation. It tends to move with monetary factors. The huge expansion we've already had in money and liquidity should mean that gold has a fair value of about $2,500 an ounce. And that's the figure we put on it. Does it mean it gets there tomorrow? No, but that's what the trend is saying. Gold is likely to move up to that, to those sort of levels. If you evaluate as a benchmark check the total value of debt outstanding worldwide, and you try and put that into constant gold terms, in other words, you said, let's say that debt and gold have a long-term equilibrium, you also get to a figure of something like $2,500 an ounce for gold. So we're fairly comfortable with that sort of figure. What does it also mean for cryptocurrencies? Well, I think I've also said, maybe I said in the last presentation, it's also very good for cryptocurrencies. And I think what you're likely to see is Bitcoin, hitting on that basis $20,000 to $25,000 per unit. I mean, it was already pretty much at the lower end of that bound. But the long-term average between, or ratio between Bitcoin and gold, if you look at the analysis statistically, is that Bitcoin trades at about 6 times the value of an ounce of gold. And that seems to be a fairly robust long-term average looking at statistical analysis of the two, of the price ratio. So gold goes up, cryptocurrencies go up, the euro goes up. I'm not convinced that Asian currencies go up because I think they're being managed against the dollar. And there is a genuine desire underscored by this, this fact I mentioned about trading zones and the need to keep currencies within that block stable. They will try and fix to the dollar. So if the dollar goes down, which it will do in the longer term, you're likely to see the euro being the main beneficiary now of the paper units. The problem with the euro is that it's extremely difficult to actually keep it down. They don't have the same array of tools in the Eurozone, the ECB or the Eurozone governments that other governments have. There's a reluctance to enact fiscal policy, and the ECB is always hamstrung by the fact that Germans and Northern European countries are very reluctant to sanction, if you like, an unrestrained balance sheet. So what you've got is an inability for the euro to rise, to stay where it is. It's got a natural tendency to rise. And the fact is that being a deflationary economic zone with demographics which are very, as we know, very poor, the euro is likely to be a strong currency anyway. That's a major, major threat to the long-term integrity of the euro area. And one of the things you've heard me say before is the simple fact that fixed currency areas like the euro are generally unstable because the rich get richer and the poor get poorer. And what you essentially need is a fiscal transfer mechanism to even that out. And the Eurozone doesn't have that yet. There's been a great reluctance to do that. And already what you're seeing, if you look at the entrails of FDI data within the Eurozone, is there's a very, very clear movement of FDI capital from the west to the east of Europe. German industry in particular has doubled its share of FDI going into the east. And this is the stock, not the flow, I hesitate to say or stress, in the last 20 years. The reality is that the Eurozone is moving eastwards, not westwards. And that's a long-term message that is, has some discomfort in it. Let me see if there are any other chats coming through. Can't see any more. Happy to dwell for a couple of minutes to see if people have got any more questions coming. If you want to unmic, do that. If there's not, I'll say thank you for your time and look forward to engaging again next month. There is, by the way, another call tomorrow at 4 p.m. UK time, where Lucrezia Reichling, who is somebody we're working with on a new fund, equity-based fund, a systematic fund, is speaking. Lucrezia was the former head of research at the European Central Bank in Frankfurt and is the architect of much of the ECB's monetary policy. She'll be fascinating to listen to, and she is talking before the notes on the launch of our fund. Otherwise, I bid everyone farewell and have a very happy holiday and a great new year. Thanks so much. Goodbye.